Are you tired of hearing the same old hype about how dividends can make you rich overnight? Here's the reality. Dividend investing can be a powerful strategy, but it's not without risks. If you're serious about building wealth, you need to understand the full picture, both the rewards and the pitfalls. In the next few minutes, I'm going to break down what you need to know, from the basics to advanced strategies, with an honest take on what works and what doesn't. Let's dive in. Dividend investing is all about earning money just for holding stocks. When you buy a dividend-paying stock, you get a slice of the company's profits. By paying dividends, they reward shareholders with regular income that can be reinvested to buy more shares, creating a cycle of growth. The steady income stream helps offset market volatility and provides cash flow even when stock prices dip. It's a powerful way to build wealth over time. So we're going to go through different types of dividend stocks. High dividend-paying companies are usually well-established and financially stable companies, like Procter & Gamble or Johnson & Johnson, or real estate investment trusts, like I discussed in my last video. There are many types of dividend stocks, each with different risk and reward profiles. We're going to go through different categories now. So there are high-yield stocks. These stocks offer very high returns through large dividend payments, but they come with more risk. The high yield could indicate underlying issues or limited growth potential. Be very careful here, as very high dividend yield stocks are often so because the share price has fallen a lot, as the yield is calculated as the annual dividends divided by the share price. And often stocks that have fallen a lot keep on falling and remain weak. In other words, you could gain on the dividend but lose more on the stock price by being in a poorly performing company. So see the chart here as an example. Have a look at the red line. This shows buying the top 15 dividend yield stocks and refreshing the list every quarter of a year, so every 13 weeks, with a minimum size of $1 billion market cap to keep out all the riffraff. You can see the red line, it goes nowhere, while the blue line, the S&P 500, goes up. In this case, you're making close to 15% per year in dividends, but the stock prices are weak, so you end up going nowhere in total. So that red line, that includes the dividends, right? That's because, as I said, high-yield companies are usually so because their share price has been weak and continues to be weak. I tested adding a requirement that dividends this year be higher than last year. That only improved the result by about 1% per year or so. So, still crap. Then, kind of medium dividend growth stocks. These stocks have moderate yields, but increase dividends consistently over time. They also examined companies that had sales and earnings growth, consistent sales and earnings growth, so they could afford to pay the dividends. You can see the results on this chart in red again. I took the top 15 companies every quarter from that scan I just mentioned, companies that were growing dividends significantly. You can see it's a lot better than the high-yield companies screen, but still worse than the S&P 500. Why? Because many high-performing companies like Apple and Nvidia hardly pay any dividends, and they are in the S&P 500. They reinvest cash flow they generate into research and development, or they buy back shares, pushing the price up. By the way, I highly recommend trying the software I'm using here for these charts. I've used it once every week for the last 12 years. The link is in the description below. The third category of dividend stocks are Dividend Aristocrats. These are top-tier companies that have not only paid but also increased dividends every year for at least 25 years. They offer reliability and are less likely to cut dividends during tough times, making them a solid foundation for a dividend-based portfolio. There is an index which tracks them, the Dividend Aristocrats, not Aristocrats, Aristocrats index. It has market capitalization, liquidity, and diversification requirements, as well as requiring that the companies have increased the dividend every year for the last 25 years at least. So the liquidity requirements include having $3 billion market cap, and the diversification requirement is that the index contains at least 40 stocks at any one time. Now you can trade this index through the ProShares ETF, Noble, NOBL. Well, how does this one do? To be honest, it doesn't do a lot better. It does a bit better than the others, but it doesn't do better than S&P 500. And that is with all the dividends reinvested.
What?
You may be getting the picture now. The dividend-paying companies can be good. Companies which reinvest most of their money in research and development and hardly pay any dividend, like Apple, Microsoft, Nvidia, and Netflix, can also be good. Building a dividend portfolio. Now that you've evaluated different dividend strategies, well, for me, I would just go with the Dividend Aristocrat strategy if I wanted a dividend-focused part of my portfolio. But if you want to build a strong portfolio by hand, keep 3 things in mind. 1. Focus on quality. Prioritize stocks with strong financial health, solid earnings, and a history of dividend increases. These will form the core of a stable portfolio. 2. Diversify across sectors. Spread your investments across different industries like utilities, consumer goods, and healthcare to reduce risk and capture growth opportunities in various market conditions. Reinvest dividends for compounding growth. Reinvesting dividends is key to compounding growth. More shares mean more dividends, which leads to even more shares, a cycle that can significantly grow your wealth over time. If there's a dividend reinvestment program, take advantage of that, because normally that enables you to reinvest your dividends at a price lower than the current market price. Normally it's 5% lower or something like that. So what's the conclusion of all of this? Dividend investing is a powerful strategy for building wealth, but it requires a thoughtful approach. And you also have to keep in mind that it might underperform high-flying index like the S&P 500. I say high-flying because at the moment it is. Sometimes, I'm sure there are some decades, maybe in the 60s or the 50s or the 40s, when dividend stocks might have worked better. But for the last 10, 20 years at least, focusing on high dividend-paying companies has been worse than investing in the S&P 500 because of the many tech companies we've had in the S&P 500 that have been booming, and they generally don't pay dividends. Now, as I showed you earlier, going for high dividend yield stocks usually causes very poor results, so don't do that. Dividend Aristocrats backtest is the best approach, i.e. large liquid companies that have grown dividends for 25 years in a row. Remember, dividend investing is about more than just earning income. It's about creating a sustainable financial future. If you want to be a more profitable investor, I'd coach quite a few people down at my Patreon channel. The link is in the description below. And please subscribe if you like the video and like. And please let us know down in the comments how you invest in dividend-paying stocks and whether you do so and what you've learned. See you in the next video, and thank you very much.